Imagine it's a regular morning. You walk up to an ATM and slide in your debit card. You're making a simple withdrawal. You know you have plenty of money in your account, but the ATM tells you insufficient funds. How can this be? You know you have enough. You run inside to ask the teller, but they explain the situation, and it's more horrifying than you thought. What happens when it's the bank that doesn't have the funds to pay you? For a lot of us, when we think of a bank, we think of a great big heavy vault where your money goes and sits until some charming bank robber carries it away. Okay, maybe not that last part. But the bank vault image is more wrong than you think. When you put your money in a bank, they're not just holding onto it for you. Otherwise, how would they make any money? As soon as you put your money in, the bank is going to use most of that money to make loans, from small credit card purchases to larger investments like mortgages and business loans. Banks can also purchase government securities to make money if no one is looking for a loan. They make money because the interest they give out on savings accounts is much lower than the interest they make on loans. Basically, when you put your money in a bank, you're giving it to them in exchange for a small cut of the money they'll make off your hard-earned dollars. When you look at your balance, you're not looking at how much money you have waiting for you in a tidy little pile. You're looking at what the bank owes you, based on what you gave to them already. So when you make a withdrawal, they don't have your cash anymore. They spent it, and they have to give you different cash to make up the difference. They get that money from their cash reserves, which is made up of a small portion of the money their depositors have given them. When individuals do this, for example, take money from other people to pay back others in a never-ending cycle, it's called a Ponzi scheme, and it's illegal. But I digress. The scary thing is that most of the money given to the bank is tied up in loans, so this system only works if most of the depositors don't ask for most of their money. Imagine you deposit $100,000 in a bank. Let's say they take $80,000 of this and invest it in loans and government securities. They leave $20,000 in cash reserves. That big bank vault we're all familiar with. Now, for the sake of this example, let's say the bank has 10,000 depositors, and all of you put in $100,000. 10,000 depositors with $20,000 of cash reserves each makes $200,000. Out of 10,000 of you putting your money in the bank, the cash reserves in this scenario only leave enough for 2 people to withdraw their whole amount. Obviously, this is an incredibly simplified example. In real life, banks can also call in loan amounts or sell securities to provide the cash needed for withdrawals. But it gives you an idea of how much banks rely on you and other depositors never wanting your money back. At least not too much of it or all at once. This is how bank runs can drive a bank to bankruptcy. For one reason or another, people lose confidence in the bank, or an economic situation drives people to take out that money. The first people get their money back, but it totally depletes the bank's cash reserves. When the next wave of people ask for their money back, it's gone. Let's look at a particular example, Silicon Valley Bank. We mentioned before that banks can use the money you deposit for 2 things, primarily loans to individuals and businesses and assets that are usually considered safe. Silicon Valley Bank put most of its deposits into US Treasury and mortgage bonds. Usually this works for a bank as part of their investment strategy, but SVB overplayed their hand. They spent too much of their cash on these bonds, which dropped in value after the Fed raised interest rates last year. To make a painful story short, SVB lost more than $17 billion on these bonds. That's not $17 billion from nowhere. That's $17 billion that came from all the people and companies holding an account at that bank. While they were suffering these losses, people began to lose faith in the bank. That's when the bank run began. In just 1 week, there were $42 billion in deposit withdrawal requests. The bank couldn't cover it, so the FDIC stepped in to take over. Essentially, the now bankrupt bank was seized from its owners and turned over to the government, who is trying to salvage things so our economy and individuals aren't hit too badly. What's the FDIC? The Federal Deposit Insurance Corporation. The governmental body who is supposed to make sure we never have another Great Depression. After the stock market crash in 1929, there was a bank run on every bank in the US and many other countries as well. This resulted in banks going out of business without paying back their depositors. Most people's savings disappeared overnight. To make sure an economic depression of that scale doesn't happen again, the FDIC insures business bank accounts for up to $250,000. Accounts belonging to individuals sometimes get more coverage, depending on how many co-owners or beneficiaries are on the account. If you're curious how much coverage you actually have, you can ask your bank or go to the FDIC's Electronic Deposit Insurance Estimator. This insurance means that even if your bank fails and they have no money left, if you have under $250,000 in your account, or however much your personal account is insured for, you can rest easy. The FDIC will make sure you get your money back. However, this didn't help many of the Silicon Valley Bank account holders. When your business account is in the millions, getting $250K back isn't much of a consolation prize. If a company had $1 million in SVB, and they tried to withdraw after the cash reserves dried up, they're only going to get $250,000. They've just lost $750,000. And for a lot of companies in SVB, $1 million is just a regular Tuesday. In fact, roughly 88% of SVB's deposits were uninsured. Luckily for those depositors, the federal government has decided that's too much money for people to lose, and they're going to cover the full amount of the losses using mostly the sale of the bank and its assets. It may also take a special charge to all FDIC banks to cover this payout, so taxpayers aren't taking the hit, but it's not a great day for the banking industry. Many are still left with a sour taste in their mouth, as this whole situation points out an inherent flaw in the banking industry. A bank's survival is mostly based on depositors not asking for their money back, and if they don't do that, the bank gets rich off their cash. Knowing all this about banks, that they are built to take advantage of you, and yet they can easily fall if depositors lose trust, how do you turn this system to your own advantage? It's simple. Forget the savings account and instead be a beneficiary of the bank's lending. Yes, you need to save your money, but there are ways to store your cash besides banks. Some of these options, like virtual investing firms, have cash accounts with much higher interest rates than banks. For instance, the national average for a traditional bank is 0.23% APY. That means if you deposit $1,000 and leave it for a year, you'll get $2.30 in interest. Given that inflation last year was 6.5%, that rate doesn't even remotely keep up. You're basically losing money in an account like that. Meanwhile, one investment automation service offers 4.05% APY on its cash account. That means if you deposit $1,000 and leave it for a year, you'll get $40.50 in interest. That's $38.20 more than a standard bank. It might not sound like a huge difference until you realize most savings accounts have more than $1,000, and over several years, it adds up. So dump your old savings account and find something with more convenience and a better APY. Just make sure they're also FDIC or otherwise insured. That investment automation service I mentioned earlier is insured up to $2 million in each account. Yes, there's still some risk here, just like with a bank. But if you're taking on that risk so someone else can use your money, you might as well get more out of it. As for your checking account, it's hard to operate without one, so you'll probably need to keep that. The way to get the most out of the banking system is to take advantage of a bank's lending policies. Some of this is simple and straightforward. For instance, by going directly to a bank for an auto loan, you'll get a much better rate than you would have got at the dealer. Similarly, many banks offer very competitive rates for mortgages, although rates change often, so make sure you shop around. The other ways you can benefit from the system require a bit more planning. If you are careful, you can take advantage of a bank's arguably predatory lending policies to make money while using theirs. One way to do this is cyclical credit card perks. At some banks, if you pay your credit card balance down a certain amount each month by a certain day, you won't incur any fees or interest. So how does a bank make money on credit cards? Because almost nobody pays off their credit card every month. To make it harder, they add perks that encourage you to spend, like cash back or airline miles. It's their way of taking advantage of human psychology. A credit card feels like free money, and it feels good to rack up points while you spend. Pay your card below your limit on time every month, and you'll get all those perks without ever paying a thing. Just make sure you read your contract carefully. Your bank is out to trick you into paying fees and interest. Stay aware of your minimum payment and when it's due, and you'll build your credit while getting free cash from the bank. By being a borrower, but not a lender to your bank, you'll get all the best benefits of the banking system, but minimize your risk should the bank fail. Just keep in mind, you don't get out of a loan if a bank fails. If you owe a bank money when it fails, the FDIC will sell your loan to someone else. You'll just have to pay the new guy the same amount you were paying the old guy. Just remember the most important takeaway. Don't keep more than $250,000 in a bank. Any more than that, you may be praying the government is willing to bail you out. Has all this talk about savings and loans got you worried about your financial health? I've got good news. You're probably doing better than you think. To find out exactly how your financial situation stacks up, click this video.